Let's do the numbers. In a nutshell, in the fourth quarter, bonds marked time, but most stocks soared. As COVID's Delta waned early in the quarter, the economy zipped along until retarded a bit at quarter's end by COVID's Omicron. U.S. large companies jumped and ended the year up 29%. Fantastic. U.S. small companies dabbled in the quarter, but still ended the year up 15%. Both are above long-term averages by a great deal. Stocks overseas returned to 8% on the year. Bonds lost 1.6%. Interest rates on the 10-year Treasury note started the year at 0.9%, rising to 1.5%. That's a big price drop. What's doing well? Corporate earnings on U.S. large companies are projected to leap again by 22% for the quarter, growing 45% for the entire year. Much of that is due to 2020 low earnings level from COVID's hit on the economy back then. Businesses are running full out, juiced by consumers with money. Earnings growth for 2022 is predicted to be slower, ranging from 5% to 9%. The U.S. economy is performing well. U.S. gross domestic product, GDP, grew 2.3% in the third quarter and is forecast to grow 5.5% for all of 2021. And for 2022, it's forecast to grow by 3.8%. Again, 2020's negative 3.5% GDP contraction was far below our normal 2 or 3% growth rate. The unemployment rate has dropped to 3.9%, close to its pre-pandemic rate. People are returning to work. Wages are rising. The U.S. now has a COVID medical bag of vaccines, medications, and treatments for both hospitalized and at-home patients. So what's not doing so well? Workers are still hard to find. The labor pool participation rate isn't budging much. Some people who retired during COVID are not returning to work. School closings are exacerbating this problem. Children are catching COVID and are just beginning to get vaccinated. Inflation rates skyrocketed in the fourth quarter due to scarce supply of some inputs, supply chain issues, wage increases. November's rate was 6.8% year over year. December's rate just came in this week at 7%. Very recent signs indicate some easing on input prices and supply chain problems. The Federal Reserve Bank's balance sheet moved from $4.2 trillion before the pandemic and stands now at $8.7 trillion. That's a lot of stimulus that's been put into our economy. The Fed has now deemed the U.S. economy and unemployment to be healthy enough to permit a pullback of this stimulus. So money supply will be dropping and interest rates will start rising. What may be ahead? Rising interest rates are a big hurdle eventually for business. Markets will likely become more volatile. COVID's Omicron may slow down businesses as employees stay home sick. We've already seen that in airlines and some manufacturing. This COVID surge is expected to be short-lived, but if it extends, the economy will be impacted even more. So what happened overseas last quarter? Developed markets didn't fare nearly as well as ours here. Europe vaccinated later than us. Their response to the Omicron variant was more restrictive. You couldn't enter a restaurant without a vaccine in many places over there. Both reasons blunted their economic growth and corporate earnings. The MSCI Overseas Index, which we use, returned only 8%. That's a far cry from our 29% for large companies and 15% for small companies. In emerging markets, China's response to COVID is severe, to lock down large segments when citing any COVID cases. These lockdowns include China's manufacturing plants, which the U.S. relies on. China's government policies also started hamstringing their technology companies last year. The result? China's market lost 23% in 2021. Very different results from ours. Bottom line, 2021 was a good run, but the easy times are over. With less stimulus, companies will have to be more nimble to succeed. The stock market remains fully valued at 21 times forecasted earnings. Volatility has returned during the first few days of 2022. Technology stocks are struggling. Interest rates on the 10-year Treasury note made a startling move from 1.5 up to 1.7%. If many of the pros are correct, you and I will see more shifts. Our diversification in the portfolios worked last year. One asset class, U.S. large caps, zoomed, while others did okay or held their ground. If history holds, diversification should work for us next year. Thank you for your interest in this. Please call or email if you have any questions. I'm glad to pass on articles I read, and I'm glad to discuss these issues more.